Crypto trading has risen heavily in popularity over the past couple of years, becoming more mainstream as the internet experiences a digital gold rush over assets like Bitcoin and Ethereum. The total market valuation of cryptocurrencies is now over $3 trillion, showing that it's not something to scoff at. It shares many similarities with Forex trading, though the two are also very different. And this video will showcase both and help you decide which form of trading may be right for you. Market landscape. Cryptocurrency trading, if you aren't aware, is the buying and selling of digital assets, usually coins, which fluctuate due to supply and demand like any other market. Forex trading is swapping one fiat currency for another in the hope that the currency will rise in value, which would then allow the trader to reconvert and profit. The mechanics that push both of these are similar, such as supply and demand. But the specific forces behind that supply and demand are very different for crypto and Forex. Cryptocurrencies, for example, are run on blockchain technology and therefore have a distributed and decentralized ledger. As a result of this, enormous investment is being put into this new infrastructure, which is causing a possibly artificial demand for crypto. Forex trading, however, has been around for decades and has a well-established infrastructure that likely doesn't result in inflated demand. It is effectively pitting one economy against another and hoping that the value of the currency you've bought will increase. Any significant imbalances, like those seen every day in crypto, could have a tremendous impact on the world economy as a whole. Market capitalization. Just as cryptocurrencies are being used to fuel various blockchain projects like NFTs, Forex is fuel to the world's economy as a whole. One benefit to cryptocurrencies, however, is that there is a clearly transparent ledger of ownership, and therefore the size of the cryptocurrency market is very easily determined. It is more difficult, on the other hand, to determine the size of the Forex market, though the closest approximation done in 2019 declared that Forex traded $6.6 trillion per day. Crypto is estimated to be around $100 billion to $500 billion per day. Forex trading is well established, and the systems and mechanisms for entering the trading space are easy to understand and participate in. Cryptocurrency, on the other hand, is much more difficult. Bitcoin has been around for a decade and a half, but it's only become easy to obtain for the average consumer over the past couple of years. Market participants. In the earliest days of Bitcoin, there were miners, retail clients, and a couple small centralized exchanges. Over the past decade, this has expanded, and now hundreds of cryptocurrencies are available on many different large exchanges throughout the world. Forex, on the other hand, has existed for a very long time on a different scale. That scale is banks exchanging their currency with other banks in order to have an established savings reservoir for other countries. Banks generally deal with each other in yards, which are 1 billion units of currencies. That's obviously much more money than the average trader could get their hands on, which makes the difference between crypto and Forex more apparent. Crypto originated with the smaller retail trader in mind, while Forex originated while only thinking of the large banks throughout the world. Profitability. It's a widely known fact, and even a meme in some sense of the word, within the Forex trading community that a majority of traders lose money. Depending on the quarter, between 65 and 75% of traders are said to lose money, with a main contributing factor to that being leverage. Leverage is a financial tool that can magnify losses and gains because it's effectively borrowing money from the firm in order to enlarge the trader's estimates. When large amounts of leverage are used, the market only needs to move a little against the trader's position to trigger a margin call, which can wipe out a significant portion of their trading account. Cryptocurrencies don't generally use massive amounts of leverage because of the severe volatility of the market, meaning that although losses may be just as common, the general losses observed do not usually wipe out an entire portfolio in one fell swoop. Forex and crypto trading have several similarities and differences, and they may not both be right for an individual trader. It's up to you to decide what kind of trading you're comfortable with, and which you believe will make you the most money in the long term.